What if the smartest tax move you've ever made is the reason you can't buy a home? And here's the part that stings. You did everything right. You listened to your CPA. You maximized your deductions. You ran your business away the way the smart business owner should. And now it feels like that was the problem. If you're self employed, a contractor, commission earner, 1099, and you've been declined or been told to come back in 2 years or approved for a loan amount that did not match your reality, this is for you. Because here's something important to understand. In many cases, the issue is not that you don't qualify. It's that your income is being evaluated in a way that does not match how you actually earn. Hi, I'm Jordan, and I work with the loan officers at Aslan Home Lending. This video is not a commitment to lend, it is for educational purposes only. If you want personalized guidance for your situation, I'll connect you with one of our licensed loan officers here at Aslan. Now, let's break down what's actually happening. There are two different numbers in your financial life: taxable income and deposits. They are not the same thing. Traditional underwriting at many large institutions like big banks focus heavily on taxable income, and that works really well for W-2 employees. It it doesn't always reflect how self-employed professionals operate. You might deposit $180,000 over 12 months, and after legitimate deductions, equipment, payroll, materials, vehicle expenses, your tax return may show that you earned $55,000. And under conventional guidelines, they're going to use that smaller number. And that disconnect creates a lot of frustration. So if you followed professional tax advice, but the underwriting model that you're using may not be designed for how you actually earn. At Aslan Home Lending, the licensed loan officers review hundreds of self-employed files every year. And one of the most common patterns we see is strong deposits, healthy businesses, tax returns that do not reflect your earning power, and the wrong qualification method being used first. There are loan programs designed specifically for people like you with complex or write-off heavy income. Some alternative documentation programs allow income to be evaluated using a 12 or 24 months of personal or business bank statements instead of relying on tax returns. In those cases, the loan officer may review eligible deposits, average them over a documentation period, apply an expense factor for the certain program, and determine your qualifying power. Tax returns may not be required when qualifying for a home using alternative documentation programs. So this does not guarantee approval. It does not apply in every situation, but it does provide a different framework. And sometimes the framework is what the issue is. The 2-year rule. You've probably heard this before. Come back in 2 years. Conventional mortgage programs typically require a 2-year history of self-employment. However, depending on documentation and current program guidelines, in certain cases, a lot of people may not have to wait the 2 years, especially if 12 to 24 months of consistent deposits can be documented. That does not mean that everyone qualifies early. It means that the 2-year requirement is tied to specific loan types and not every possible solution. Waiting may be the right move in some cases, but in others, there may be a structured alternative that works for you. So let's talk trade-offs. Non-QM programs often carry different pricing structures than conventional lending. And that trade-off exists because the qualification method is more flexible. For some borrowers, this can function as a strategic bridge. They secure the home using alternative documentation. Then later, if income documentation or equity aligns, they can refinance into that conventional structure. Some self-employed professionals choose this route because they prefer not to restructure how they file their taxes just to qualify for a home. That's a strategic decision, not a compromise. But it should always be evaluated carefully with a licensed mortgage advisor. If you've ever sat across from someone reviewing your paperwork and it felt like the numbers did not reflect your reality, that frustration makes sense. Your tax return is designed to minimize what you owe to the government. It's not designed to show a lender your full earning capacity. Those are two different purposes. Often, it's not that you don't qualify, it's that your income is being measured the wrong way. If you're self-employed and you're unsure of what's actually possible, click the link in the description below to schedule a mortgage chat with an Aslan expert. You're going to walk away knowing exactly where you stand, because this isn't about pushing you into a loan. It's about helping you understand what options exist. Thank you so much for watching. Like I said, my name's Jordan, and I'll be back here each week with home buying education, specifically tied to self-employed, non-conventional financing. So hope to see you soon. Like and subscribe if you enjoyed this content.